Hey everybody, this is David Skarica, stock chart of the day, December 19th. Real interesting day yesterday to say the least. So I am going to put this in my members section, but at the end of the year. I just want to show people this is the kind of thing I do for members. This is going to be a more overview, detail overview of everything. Remember, because at some point, really, I should mention this in a second, when I really start trying to build this service subscription wise. Right now, I'm kind of just building content because really the launching pad for me to kind of I guess like you said, my reinvention will be when my book is published in March. And when that happens, what happened is uh when my book is published in March, I'm gonna I'll launch my Substack, etc. And I think even this service is gonna change to maybe like two updates a week, and then I'm gonna have 2 to 3 updates a week. And actually, I'm gonna have little daily vlog updates for my Substack and my lifetime members. So it's gonna be much more active, and this is just gonna kind of be whatever. But what I want to show you is this is kind of like what we do if I talk about more macro things. So of course, the Fed um cut rates, but it looks like now if we go look at the CME, they're not going to cut rates really at all. Actually, there was some weird thing in the futures yesterday after they cut. That's now out of the market. But there was a weird thing in the futures where there was actually a chance of a rate hike next month. Now that's out. So you can see there's still about a 50-50 chance of a rate cut. Oh, that's March. Sorry. This is here. Yeah. There was a chance of a rate hike afterwards, but now you can see that's 91% doing nothing. So there's still 50-50 going out to March, going out to May, about 60-40, June. But basically let's go out to December. So let's go out a year, basically. You can see now there's a chance of one rate cut all of next year. I don't even think they're going to cut rates unless there's some kind of, big meltdown in the stock market, economic crisis, etc. And we could get that, especially I've talked about these sky high valuations. I've talked about how it does look like by the reaction to this omnibus bill in the United States that these factions of the Republican Party that do want to cut spending, the Doge program, etc., they're starting to kick in because these omnibus bills, we all know they're full of pork, right? And they have all these nonsense spending in there that they shove in, and this was kind of the last hurrah, I think, for that sort of thing. And the excuse was by the Speaker of the House, Johnson, was that we just push this, we'll just push everything out to March, and then we can start doing our cuts, right? But this was just a way for them to get some of those programs or some of that money through. So anyhow, and I don't think it's going to happen personally, So, but it also shows the problem with doing large scale spending cuts that I have discussed. That you got these big government Republicans in there. They only have about a 10-seat advantage in the Congress, right? So the problem is, if six vote against it, and all the Democrats are going to vote against spending cuts, well, then they can't pass it. Now, you can do a lot of these things for executive orders. There's a lot of these new government agencies and programs that have basically were set up years ago that say got 2-3 years of funding and they're 6 years in, so you can just let that expire and basically get rid of the agency. So there are other ways to do it. But if you really want to cut 1 trillion, 1.5 trillion of that non-discretionary spending, that's what you have to do. But we're going to get back to the market. So of course, the Fed did that. I just showed you what the projections are for interest rates, and you can see the VIX had a big spike. Now, this is where I've really learned over the years. I've been so paranoid over a big crash for the last 10 years. After 2008, it's kind of like you become, I don't know, say a victim of your experiences, or, you learn from your experiences. And a lot of people after 1929, that generation, like that was my grandparents' generation, they didn't invest in the stock market. And the reason being was, they saw 1929, they saw the market go down 90%. They saw people wiped out. They saw people, jumping off buildings and that sort of thing. So I made that generation much more conservative. And of course, they actually missed out on one of the greatest bull markets ever of the 50s and 60s because stocks became very cheap in the 40s after 2 decades of doing nothing. So anyhow, but anyhow, what I'm saying is I had kind of the same mentality is that I wasn't really bearish on the markets till about 2014, 2015. I actually, at a conference we did in the Bahamas in 2009, right near the bottom of the markets, I was the only bullish one there. Everyone was looking for the S&P to go to 400, and I was like, this is basically the bottom. And I was buying Tata Motors at 350 and this sort of thing. So it's like, I know because that's the problem when I wrote those two bear market books back in the mid 2000 teens. And look at this has just been one of the greatest bubbles ever. If you go look at fundamentally, I was right back then. Like, even though the markets, you could say, doubled since then, the S&P more than doubled, but market cap to GDP, which is a good long-term indicator, started to become vastly overvalued in about 2014, 2015. But the market can remain irrational longer than you can remain solvent. So I didn't go bankrupt. I did a few shorts here and there. I actually made money shorting in 2015 and 2022. But then I had a lot of junior mining deals do well. A bunch go up 10, 15 times over that time span, and that kind of kept my head afloat. Of course, I wish I just would have bought Nvidia and Amazon and Apple and forgot about everything for 10 years, or even bought in resource sector, bought uranium, bought Cameco in 2016. Again, forgot about it for 8 years. But that's 2020's hindsight, right? So anyhow, when you see these kind of big spikes here in the VIX, usually you see some kind of short-term bottom. Like this was when the yen trade kind of blew up a bit back in early August, and now we have this kind of, I guess you could say, interest rate trade blowing up here. So you look at this. Can we go back here? I doubt we're going to go to 60 on the VIX 2 times within 6 months, but we got to almost 30 yesterday. To me, this feels like something very short term. Go look at 2022. That was kind of the bottom of the bear market. 2023 you saw actually in the spring to 30. So could we go to like 30 or the whatnot? Yeah, sure. So but I think this is going to be more a short-term deal. Like, look, the S&P is basically coming right off the top. Yeah, we look at here, you see it trended slightly lower from almost 6,100 to 6,050, so not even percent. And then boom, it fell almost 3% yesterday. So we're only off 4% from the highs. This is not like, you know, some end of the world scenario, and you can see this moving higher. But I think what this shows us is when the market gets overvalued, like it was, say, in 2020, and COVID decimated it for a month or two, it becomes more susceptible to these kind of declines, right? Because the market is so overvalued, and the shocks hit it more because it's got to adjust for the overvaluation, adjust for being priced for protection, right? Let's go look at the Nasdaq 100. I'm sorry. Yeah, and you can see that here, and that fell actually 3.6%. That was essentially coming right off the top. But again, you can see this kind of trend higher, et cetera, et cetera. So we have done virtually no technical damage, and we already have the VIX now at 27, 28. So that doesn't mean this can't be the start of a larger correction, that maybe these markets go down a little higher. But I would definitely think, even if this is kind of the end, because this interest rate trade, I still don't know if it's not. Sorry, if it is, because the Fed cut 100 basis points. Like if we go back to 1995, which I'll show you in a second, we'll go. This is where we're look. This is a 3-month T-bill. So we'll get a 1.5-year chart of this, and you can see this was at 525 in the summer, and now it's at 425. So this has gone down 100 basis points. Well, if we go back, we're going to go back 50 years on this now, and you can see here when 1995, you can see, look how slight the interest rate cuts were in 95. This went from basically 6 to 5. I think it was actually 5.75 to 5. So it went to 75 basis points from a higher level. And, the market zoomed in 95, 96, right? So just having like minor interest rates cuts, like you see, look at this here. This was like 2.25 to about 1.5. So 75 basis points. So less, again, than the 100 that we've seen in 2019. And if we go look at the S&P in 2019, what we're going to see is, again, so let's look at 95. Look at this here, like this huge move here, right? S&P was about 400 or so. And then by the end of 1996 was 750, so that's what it did. And they didn't cut rates in 1996, So, and if we go look at a shorter term chart, so we can go look at let's go look at a 10-year chart so we can see 2019. What we'll see is after this bear market in 2018, look at 2019, what the market was doing. Again, only 0.75 of a point. And before COVID, because the market was heating up again, they were talking about turning around and starting to raise rates again. So, like, that's the whole thing. Like, when you're in a loosening cycle, like that whole bull market of the 1990s, other than the couple rate cuts they did in 1998 because of the Russian crisis, there was essentially no real rate cuts after those 95 rate cuts. Again, let's just go look at it. So because I want to look at these things in detail, right? Go to predefined range, start select. So we're going to go to 1994 and we'll end it at 2000 so we'll see that bull market at 2000. So here you can see the S&P almost straight up for years. And then let's look at let's go look at the short-term rates, which basically track the Fed funds. Yeah, go look at after that 95 rate cuts that I talked about, which were roughly 75 to 100 basis points, basically sideways all the way through 1998. I think there was one little rate hike in 97, if I'm correct, like a quarter point, but then they cut those rates here and they were emergency cuts, and then they were taken back pretty quickly in 99. And then they, of course, raised rates, which led to the bear market and tech wreck of 2000, et cetera. But you can see this huge bull market on the S&P, which I just mentioned. We'll put that back up, of 450, to, 1500 basically occurred, again, at a time frame when interest rates, for the most part, like you draw a line here from when they started cutting in early 1995, a line here to here in 2000, interest rates were flat that whole entire period. So, that just shows you, or did this late 95, I mean. So, or interest rates basically that entire period went, you could say, from 575 to about 5%. It went down only 75 basis points that whole period. Now, there was less debt back then. We had the internet.com boom. We had the end of communism, all the people joining the global market, countries in the Eastern European countries, China, India were really opening up their economies in the 90s. All these different reasons for this boom of the 90s. But the fact of the matter is the Fed didn't really have to cut rates. We're so used to, since 2008, to have these bull markets, or really actually even since, I'll show you those now. Really since 9/11, we're used to like the Fed having to cut. You can see the Fed funds rate went to almost 0.5% here from that 5%. And then if we go look at 2008, again, it was 5% here. It went to zero. I'll take the log scale off so you can really see it. Yeah. And then again, during COVID, we went from 2% to here. We're so used to the Fed in the last basically 20 plus years having to put rates to zero to trigger these bull markets and recoveries. That doesn't have to be the case. Now, the issue now is the debt is so high. And I saw Powell make an insane comment. To me, it was an insane comment. It was a nonsense comment, and it kind of scares you when the guy who's the head of the Federal Reserve is making comments such as these. And he said that, they only look at monetary policy, they don't look at fiscal policy. Well, that's an asinine, because if the national debt goes to 40 trillion and say the average interest rate on that debt is 4%, that's 1.6 trillion in interest payments. Those interest payments were like 400 billion around 2020. So you have 1.2 additional trillion dollars, which would probably just go to increase the deficit, which then, of course, it makes it even larger, which then, of course, increases the interest rate and becomes like a snowball effect, right? It gets bigger and bigger and bigger as that debt snowball, interest snowball rolls down the hill. So that just tells you how to touch these guys are, right? So fiscal and monetary policy have to work together, because when you basically have these huge deficits, at some point the Federal Reserve is going to have to cut rates and print money to subsidize those deficits. Like you look at all these countries that have hyperinflation, like in the last few years, like Turkey or Argentina. Okay, they had huge high interest rates and hundreds of percent, but it was actually below the rate of inflation, way below the rate of inflation, because when they were going through those periods of hyperinflation and a debt crisis, they have to inflate away the debt. Now, I don't think we're going to go that extreme here, but like I think what will happen is ultimately the short end is going to be way below inflation. Like they could still cut the short end ultimately to 3% over the next couple of years. The long end may not, because the long end might reflect more what's going on with inflation. But that short end is going to have to go down. Why? Because most bonds are short end, most US government debt is 1, 2, 3 to 5 year bonds. So they need that rate down at, to pay it off. And then also keeping that short end down will help increase inflation. So you can also inflate away the debt to a certain degree, right? So Anyhow, so I just thought this was interesting about interest rate cycles. So what we have to remember too is let's go back to 2013. I don't know if you remember what happened in 2013, but there was something that was called the taper tantrum. And if you can see it right here, this little spike here in rates is that the Fed basically said, if you remember that time, they were doing QE, they were pumping asset markets, et cetera, et cetera. And you can see that decline here in decline. Yeah, right here. See this here? That was it in 2013. Even though that doesn't look like a big decline, the market did go down about 6-7% on that decline. And you can see that there. And that was because the Fed said they're going to basically stop QE by the end of the year and unwind it throughout 2014. So, and you can see actually when they unwinded the QE in 2014, the market kind of did nothing for the next year or two. So that's when I thought there was going to be a big bear market, and there were a couple corrections, and the market did nothing for almost 2 years. So I was a little bit correct in that point, but I didn't get the big watershed decline like I thought. So then of course we had COVID and we had more zero rates and all this kind of stuff. So anyhow, but I just wanted to show you. So could it just be this kind of decline? Like I said, let's just go look at more just the 2013 year, and we go look at that. And like I said, that's the taper tantrum. See these big declines here? See that big spike here? And you can see actually a few days later, it bottomed and went up. So that's what we have to ask ourselves. Let's just quickly look at the VIX there. And then you can see it didn't go as high as it did now, but look at that VIX spike, right? It was like 11 and almost doubled to 21, 22. So that's what we have to ask ourselves. Is this just like August? Is it like the taper tantrum of 2013? Is this something like that going to happen? And then when people wake up and realize, well, okay, the Fed's not cutting rates, but they're not going to raise them either, because they're definitely not going to raise them. Like inflation would have to really start taking up to 4, 5, 6% for them to raise them again. We should be okay here. So that's why I don't want to like panic too much. But here's another thing, and I've talked about this, and I just want to show you this again because we're in the 99th, we're actually in the 100th percentile because it's never been this high. And you can see it's at 200 now, but this actually got to 207 a few days ago at the market's top. So this is the market cap to GDP. This is the Warren Buffett indicator, and it shows you the valuation metrics here. If you're under 84%, I'd say really more under 3/4, 75% is undervalued. 84 to 108 is modestly undervalued. I don't even agree with that. This is just because the last 10 years has skewed these numbers because we spent so much time above 100. Anything over 100 is usually overvalued, right? So you could say my number is a little different, but anyway, let's just use these numbers. 108 to 104 is fair value. 132, again, I disagree with that because historically, if we go to this, like, let's get the all time, you can see we never really spent time above 100 until the late 90s. So anyhow, but let's just use these numbers for now. And 132 to 156 is modestly overvalued. I would consider that to be very overvalued and significantly overvalued, or I would say asinine is over 156. We've only really gotten to 156 over that twice. And again, this is skewed because that's now been, this goes back to, you can see 2020 here. April 2020 was 150%. We've spent basically most, other than a few months at the bottom in 2022, of the last 4 years over 200%, which is kind of a statistical anomaly. Just like spending a few years here in the 70s from 75 to like 82, like at under 40% was like a statistical anomaly. This is as well. So this is the problem with the Fed stopping, and which makes it different. Like we talked about them only doing a few cuts in 95. Well, 95 market cap to GDP was 63%. Now it's 200%, right? So even in 2018, 2019, when they just did a few cuts, it was 132%. So we're 70% higher than that now, right? So we just have to look at this, as well. So that's the issue going forward. But I just think now you got the short-term panic going on in the market. You have the Dow down to 1,100 points. All right, 2.5% is not that big. What's interesting about the Dow, though, I don't know if those of you know this is 11 straight down days on the Dow, and you can see 12 of the last 13. This is 13 of the last 14. This is the longest losing streak on the Dow in 50 years. So basically since the 74 bear market. Yeah, and this is happening at the top of the market. The one thing I just want to show you a few more things here that I thought was asinine about the Trump trade was these banks. There was a hope that they were going to deregulate the banks, and maybe they will, but you can see that bank rally post-election is totally gone now. Like that was the one trade that really surprised me. I was looking for oil and gas companies to rally, defense contractors, um, some of the smaller maybe retailers, because tariffs help them because they're more US based, things like that. But the banks I did not expect to be one of the huge trades, and you can see that they were. The banking index was about 120 before the election and went as high as 140. It went up. Yeah, these aren't .coms. These aren't crypto. This is up 16% in just a few months, right? This is insane. This is asinine. This is crazy. You know, uh, it's just insane. So, and if we go look at some of the banks themselves, look at JP Morgan, you can see that stock there. Let's get the daily view. So, JP Morgan, you can see again, almost taking out this, but it went from 220 to almost 250. Goldman Sachs, same thing, just over 500 to over 600. Bank of America, same thing. They all look the same. The gap ups, and of course yesterday the big moves down. Citigroup, same thing. So that's a crazy trade, and it looks like we might close these gaps now. And these look like to me like they've topped. So another thing that's interesting to see is look how poorly the home builders have done. I think this is a great shorting opportunity at some point. Not now. Again, this is where I talk about learning from history. You don't short when the RSI is 22. It's broken through the moving average, but maybe we rally back to the 200-day, which would be a nice little 200-point jump, about a 10% move from here. And that's when they get in. So then if you look at BH, Benar, DH Horton, sorry, DHI. Yeah. All of these things are potential, Toll Brothers. All of these things are potential shorts, in my opinion, on a bounce here. Because, we're seeing, again, let's go to the 10-year bond. We're seeing interest rates, you can see they're up again more this morning to 4.55. We're in now basically, other than this little thing in May, we're basically, about April, May, we're at the highest level. Let's get a look at a longer term chart here in interest rates. You can see here. And if we break this 470, we could be going back to the 2023 highs in interest rates, which you can see we're almost 5%. So if we break this 470, and again, you draw this line here, other than this little spike in May, other than this little spike here in May and June, we're essentially again at the highest level since 2023. This didn't last long too. So, as well. So, and by the way, that's the issue. Okay, let's get to gold. Gold's obviously been disappointed. I've been saying for a while that gold was going to see,